In our basic example, we took for granted that we knew what the lease payments really were, and we assumed that they were $100 each year. However, a lease contract may include certain complexities as to what payments would be made during the course of the lease term. Some of them might be fixed, some of them might be variable, some of them might be dependent on some contingencies, some of them might be dependent on exercise of certain options. So for that, it is very necessary to understand the exact definition of what lease payments have to be included in such a lease transaction, and what to do with the lease payments which are not part of such lease transaction. And to be very straightforward, those lease payments which are not part of the definition will have to be expensed out in the books of the lessee in the year in which they were incurred, and they will have to be recorded as income in the books of the lessor in the year in which they were incurred, which means these payments, if they are not part of the lease payments, would be treated individually as an individual expense or income. They will not be part of the entire setup of accounting for the lease as a whole. So what to include in the lease transaction, in the lease accounting? Standard says that lease payments are the payments made by a lessee to a lessor relating to the right to use an underlying asset during the lease term, comprising the following: fixed payments, variable payments, the exercise price of a purchase option, and the payment of penalties for terminating a lease. Now, we'll look into each of these in a bit more detail. First of all, what are the fixed payments? Fixed payments are the fixed amount of payments that have been included in the contract, just like we discussed in our simple example. There are simple fixed amounts that have to be paid at periodically, or the amount specified in the contract. And these payments also include in substance fixed payments. We'll talk about what in substance fixed payments really are in a bit, after we talk about what variable lease payments are. So what are variable lease payments? Variable lease payments are that which depend on something else. Now, there are two kinds of variable lease payments according to standard. One which will be included in the lease transaction, and the other which will have to be expensed out separately. So variable means that anything that varies with something else. For example, if the contract includes a term that if the asset performs above average or above a certain performance criteria, the lessee will have to pay $20 more. So if the lease payment was $100, the lessee will have to pay $20 more if the asset performs really well. So these are how the variable lease payments are designed. They vary with some contingency, some happening that would happen in a future time. So this is one kind of variable lease payments. So other kind of variable lease payments are that depend on an index or a rate. For example, interest rate, or for example, the inflation rate. So if the inflation increases, the lease payments will have to be increased. So those variable lease payments which are linked to an index or rate are included in the definition of lease payments. But those variable payments which are not dependent on index or rate and vary with something else like performance of the asset, those payments are not included in the definition of lease payments. Now, we talked about variable lease payments, but there might be certain lease payments which will vary depending on a contingency, and that contingency is very remote. For example, if I say that the lessee will have to pay extra $200 in the year in which all of the country's banks default. Now, all of the country's banks defaulting is a very, very, very rare possibility, remote possibility. And because this possibility is so remote, these payments will not be considered variable, rather, because the possibility is not expected to occur, therefore the payment is not expected to be made. So these payments will be considered in substance fixed payments. And obviously in substance fixed payments, which means those payments, if the original payment was $100 and the variable component was $200 extra, which could have made it $300, the in substance fixed payment is actually $100 because those extra $200 are not expected to be paid because they are contingent on a very remote possibility. So first we talked about what the fixed payments are. They are the fixed periodic payments, and then we understood what the in substance fixed payments are. They are additional payments that are dependent on a remote contingency that is not likely to occur. And then there are variable lease payments, and we talked about there are two kinds of variable lease payments. One is dependent on index or rate, for example inflation rate. For example, if the contract say that a lease payment will increase if the inflation increases, in that case we would say that the variable lease payments are included in the definition of the lease. However, if there are variable lease payments which depend on, for example, the performance of the asset going above a certain performance criteria, or the performance of the business using that asset increases above a certain level, all those contingencies are specific to an individual business, individual asset, and those variable lease payments are not included in the definition of the lease payment. And if they occur, they would be treated separately as an expense or income in the books of lessee and the lessor. Now, third part is the exercise price of a purchase option if the lessee is reasonably certain to exercise that option. For example, if an asset has a useful life of 5 years and that lease had actually been arranged for 4 years, and at the end of the 4th year, if the lessee is reasonably expected to purchase that option, in that case that purchase price will also be included in the lease payments, and the lease would be accounted for accordingly. So any exercise price for a purchase option, if the lessee is reasonably certain to exercise that option, is included in the lease payments. And lastly, payments of penalties for terminating the lease, if the lease term reflects the lessee exercising an option to terminate the lease. So when we were learning the definition of the lease term, we understood that if the lessee is reasonably expected to terminate a lease before the lease term, then that shorter period would be the lease term. So for example, if the lease term was actually originally 5 years, but the lessee is expected to terminate that lease at the end of the 3rd year, in that case the lease term would be considered the 3 years. But if to exercise that option, the lessee will have to pay some penalty, and obviously we are determining the lease term as 3 years because we are expecting that the lessee will reasonably terminate the lease at that point in time. In that case, we should also expect that those penalties will also be paid because they are part and parcel of the same term which allows the lessee to terminate the lease. So those termination payments, those penalties for terminating the lease, are also part of the lease payments. So this is what forms lease payments. First, the fixed payments and in substance fixed payments, and then the variable lease payments that depend on an index or a rate, and then third, the exercise price of a purchase option if the lessee is reasonably certain to exercise that option, and then the payments of penalties for terminating the lease if the lease term reflects the lessee exercising an option to terminate the lease.